Metal markets are cracking, but beneath the breakdown, a bigger breakout may be building. Fear is flooding into gold. Pressure is piling onto silver. And yet this sudden slump could be setting the stage for something far more powerful than anything we have seen in this cycle so far. Gold is having its worst week in months. Prices are sliding, sentiment is souring, and the headlines are turning sharply bearish almost overnight. Investors who were celebrating new highs just weeks ago are now watching the metal lose momentum. And for many of them, it feels like the rally may finally be running out of steam. That feeling, that sense that something which was working has suddenly stopped working, is one of the most powerful emotions in markets, and it is also one of the most unreliable guides to what actually happens next. At the same time, silver has pulled back even harder. It has fallen well below its recent highs after a sharp and sudden correction that caught a lot of recent buyers off guard. On the surface, it looks like the precious metals trade is breaking down completely. The narrative writes itself. The run is over, the smart money is leaving, and it is time to move on to the next story. But that is only half the picture, and it is the half that historically has been the least useful one. Because when you step back, when you stop looking at the candle on today's chart and start looking at the broader pattern these metals have followed for decades, what you begin to see is something very different. Not a collapse, but a classic cycle. Not a breakdown, but a reset. And possibly the kind of reset that long-term investors spend years waiting for, because it is the moment when price and value temporarily disconnect. And that disconnect is where the opportunity lives. My name is May, and this is The Untold Empire, the channel where we track the shifts in the global financial system before the headlines catch up. And today we are going to take this pullback apart piece by piece, because understanding why it is happening tells you almost everything you need to know about what comes after it. So let's start with what is actually happening right now, in plain terms, before we get into why. Gold is currently on track for a weekly loss of about 2.8%. That is a meaningful move. It is not a rounding error, and it is not something to dismiss. In a market that usually trades with relative stability, where multi-percent weekly moves are the exception rather than the rule, a drop of this size gets attention. It shows up on every trading desk screen. It generates headlines. It changes the tone of the conversation almost instantly. But here is the first thing worth understanding clearly. The primary driver behind this decline is not a sudden change in gold itself. Gold did not become less scarce this week. Central banks did not stop wanting it. The structural case for the metal did not evaporate overnight. What changed is something entirely different. A shift in expectations around interest rates and the strength of the US dollar. When markets begin to believe that the Federal Reserve may keep interest rates higher for longer, or even raise them further from here, that belief creates immediate pressure on gold. And the reason is mechanical, not emotional. Higher interest rates increase the opportunity costs of holding non-yielding assets like gold. Gold does not pay you anything. It has no coupon, no dividend, nothing that compounds while you hold it. So when a treasury bill or a savings account starts paying 4-5% with essentially zero risk, every dollar sitting in gold becomes a dollar that is conspicuously not earning that return. That gap between what gold pays and what safe alternatives pay is something institutional money watches constantly. And when it widens, capital moves. At the same time, a stronger dollar makes gold more expensive for buyers outside the United States. Gold is priced globally in dollars. So when the dollar strengthens against other currencies, a buyer in Europe, in India, in Japan, anywhere outside the US, is effectively paying more for the same ounce of gold in their own currency, even if the dollar price has not moved dramatically. That makes gold less attractive on the margin, and it tends to reduce demand in the short term, right at the moment when the headlines are already turning negative. And that is exactly the combination we are seeing right now. Rate hike fears are resurfacing. The dollar is firming. Bond yields are pushing higher. And in response, predictably, mechanically, gold is pulling back. Silver, which is typically more volatile than gold by a wide margin, is feeling all of this pressure even more intensely. After a strong run earlier in the cycle, it has now corrected sharply, and that sharp correction has left a lot of investors questioning whether the rally was overextended to begin with. Whether the move was real or whether it was simply speculative excess that has now been wrung out of the market. But here is where things start to get genuinely interesting. Because if you look at silver on a slightly longer timeline, not the last week, not the last month, but the last year, it is still massively higher year over year. Despite the recent drop, despite the sharp correction, despite the headlines calling the move overextended, the broader trend remains fully intact. And that single fact tells you something important. This is not a collapse driven by fundamentals deteriorating. If the fundamental case for silver had actually broken, if industrial demand had collapsed, if central banks had stopped buying, if the inflation and debt dynamics driving this entire move had reversed, then a correction like this would be the beginning of something much worse. But none of those things have happened. What we are looking at instead is a correction driven by liquidity, positioning, and short-term sentiment. Three forces that are powerful in the moment and almost entirely temporary in nature. And this is the part that most people watching the headlines right now are missing entirely. Precious metals have a long, well-documented history of behaving exactly this way. They often sell off hardest during moments of tightening financial conditions, when liquidity gets pulled out of the system, when real yields rise, when the dollar strengthens. In those windows, gold and silver tend to struggle, sometimes badly, even while the long-term case for holding them is strengthening underneath the surface. That is not a contradiction. It is how these cycles have always worked. But here is the part that matters even more. Those same tightening conditions, the higher rates, the stronger dollar, the rising yields, are very often what create the stress that eventually drives gold and silver higher in the next phase. The very mechanism causing the pain right now is historically the mechanism that sets up the next move. That is not a coincidence, and it is not wishful thinking. It is a pattern that has repeated across multiple decades and multiple economic cycles. And understanding it is the difference between seeing this pullback as an ending and seeing it as a stage. Now let me connect the dots, because this is where the real story is. When central banks raise interest rates aggressively, their stated goal is to control inflation. That is the textbook explanation, and it is true as far as it goes. But at the same time, and this is the part that rarely makes it into the mainstream coverage, they are also increasing pressure on debt markets, on governments, and on the broader financial system all at once. Higher rates mean higher borrowing costs, not just for individuals with mortgages or businesses with loans, but for governments themselves, who are among the largest borrowers in the entire global economy. And in a world that is already loaded with massive debt, a world where government debt levels have grown to historic proportions across nearly every major economy, that pressure does not build slowly. It builds quickly, and it compounds. We are not talking about small numbers here. Global debt levels are sitting at historic highs. Governments across the developed world are running large, persistent deficits, and the cost of servicing that debt rises every single time interest rates stay elevated for longer. Every percentage point of higher rates translates directly into billions, and in some cases, trillions of additional interest expense that has to be paid out of government budgets that are already stretched. So while higher rates may temporarily strengthen the dollar and weaken gold, which is exactly what is happening right now, they are also simultaneously creating deeper structural problems underneath the surface, problems that do not disappear just because the headline price of gold went down this week, problems that accumulate quietly in the background, even while the price action looks calm or even bearish. And eventually, not immediately, but eventually, those accumulated problems force a response. That response historically comes in one of a few familiar forms: monetary easing, liquidity injections into the financial system, or what economists call financial repression, where policy is deliberately structured to keep real returns on safe assets low so that the burden of debt gets eroded over time. In simple terms, central banks eventually have to step back in and support the system, because the alternative, letting the pressure build until something breaks, is politically and economically far more costly. And when that support arrives, when the liquidity comes back, when rates start coming down, when the system shifts from tightening to easing, that is historically when hard assets like gold and silver tend to surge. Not drift higher, surge. Because all of the structural demand that was building quietly during the tightening phase suddenly has room to express itself in price. So what you are actually seeing right now is a tension between two forces operating on completely different time frames. On one side, you have the short-term force, tightening financial conditions, higher yields, and a stronger dollar, all of which are actively pushing metals down right now, today, this week. This is the force that shows up in the headlines. It is the force that drives the day-to-day price action. It is real, and it is currently winning. On the other side, you have the long-term force, structural stress building in the system, persistent inflation pressures that have not gone away even when headline numbers fluctuate, and rising debt levels that are not improving no matter what the weekly chart looks like. This is the force that does not show up in a single day's trading, but that accumulates steadily underneath the surface, week after week, month after month, until it eventually becomes the dominant force in the market. Right now, today, the short-term force is winning. That is simply a fact, and pretending otherwise would not be honest. Gold is down, silver is down harder, the narrative is bearish, and in the very short term, that narrative is being validated by the price action. But that does not mean it will last, and the reason it likely will not last is that the broader macro backdrop driving the long-term force has not actually changed, not even a little. Inflation pressures are still present in the economy, even when the headline inflation numbers move around from month to month and occasionally come in lower than expected. The underlying cost structure across the economy remains elevated. Housing costs, energy costs, food costs, and the cost of services all continue to reflect long-term inflationary trends that have not been resolved. They have, at best, been temporarily masked by base effects and short-term fluctuations in specific data series. At the same time, geopolitical risks are not going away. If anything, they are intensifying. Global tensions, trade fragmentation between major economic blocs, and strategic competition between the world's largest powers are all contributing to a more uncertain world. And uncertainty is not a temporary condition right now. It is becoming a permanent feature of the environment. And in environments like that, central banks and large institutional investors consistently respond the same way. They increase their allocation to hard assets that exist outside the traditional financial system. And that brings us to one of the most important signals in this entire story, a signal that almost nobody is talking about in the middle of this sell-off. Central banks are still buying gold aggressively, right now, during this exact pullback, while retail sentiment is turning negative and headlines are calling the rally exhausted. The largest, most patient, most informed buyers in the entire global financial system are continuing to accumulate at a steady pace. That divergence matters enormously, and here is why. Short-term traders may be selling because of a shift in rate expectations that could reverse within weeks. But central banks are not buying gold for short-term trades. They are not trying to catch a bounce or time a quarter's performance. They are buying gold as a hedge against currency risk, against geopolitical instability, and against systemic uncertainty in the financial architecture they themselves are part of. Their actions reflect a multi-year, in some cases multi-decade, view of where the global financial system is heading. So when you see gold falling in the short term, while central banks continue to buy steadily underneath that decline, you have to ask yourself a genuinely critical question. Is this a sign of weakness in the gold trade, or is this a window of opportunity that is being created precisely because short-term participants are reacting to the wrong time frame? Now here is where this gets serious, because the policy dynamics underneath all of this are not simple, and they do not resolve cleanly. If the Federal Reserve continues to keep interest rates high, or raises them further, as current market pricing suggests is a real possibility, the pressure on the broader system will continue to build. That means more strain on banks, who have to manage the gap between what they earn on long-duration assets and what they now have to pay depositors. It means more stress in credit markets, where companies that need to refinance debt at these higher rates face a meaningfully worse cost structure than they did just a few years ago. And it means more difficulty for governments managing their own debt loads, as the interest expense on that debt continues climbing. But here is the trap. If inflation proves sticky, if it does not come down smoothly and instead remains elevated or even re-accelerates, the Fed cannot easily cut rates without risking a renewed surge in prices that would undo years of credibility-building work. And yet, if they keep rates high for too long in pursuit of that inflation target, they risk breaking something somewhere else in the financial system. A bank, a segment of the credit market, a part of the economy that simply cannot function at these borrowing costs for an extended period. This is what many analysts refer to as a policy trap. And in a genuine policy trap, there are no easy choices left. Every option comes with real consequences attached. Cut rates too early, and inflation could re-accelerate, undermining the very credibility the central bank has spent years trying to establish. Keep rates too high for too long, and financial instability could emerge somewhere in the system, somewhere that may not be obvious until it happens. And in both of those scenarios, both branches of the trap, gold and silver become increasingly relevant. Because they are not tied to any single policy decision, they are not liabilities on anyone's balance sheet. They are not promises made by a government or a central bank that depend on that institution's continued credibility. They are assets that exist outside the traditional financial system entirely, with value that does not depend on anyone's ability to pay. So when confidence in that traditional system begins to weaken, even slightly, even in ways that do not make front-page news, demand for hard assets tends to increase. Quietly at first. Then, eventually, not so quietly. And this is exactly why these short-term sell-offs can be so genuinely misleading for people who are not looking at the full picture. They create the impression that the trend has reversed, that the story is over, that the opportunity, if there ever was one, has already passed, and the smart move now is to wait for some other calmer entry point. That feeling is completely understandable. It is how human psychology responds to a chart that is moving against a position you hold, or against a thesis you believed in. But in reality, these pullbacks are very often part of the process itself, not a deviation from it. Markets do not move in straight lines. They never have, in any asset class, in any era. They move in cycles. They build, they correct, they consolidate, and then they move again, often further and faster than anyone expected during the consolidation phase. And in many, many cases throughout market history, the strongest moves of an entire cycle come directly after the sharpest pullbacks within that cycle, not after calm, steady grinding higher, after the moments that felt the most uncomfortable to hold through. So here is where we actually stand, all of it laid out together. Gold is under pressure. Silver has corrected sharply. The dollar is strong. Yields are rising. And sentiment across the market has turned cautious, bordering on bearish. All of that is real, and all of it is currently visible on every chart and in every headline you could pull up right now. But beneath that surface, the larger forces we have spent this entire conversation walking through are still fully in play. Inflation has not been fully defeated. It has been temporarily quieted in the data, but the underlying cost pressures remain. Debt levels remain extreme, and they are not improving regardless of what the weekly price action looks like. Central banks are still accumulating gold, steadily, deliberately, through this exact period of weakness. And the global financial system continues to face the same structural challenges it was facing before this pullback began. Challenges that a few weeks of price action cannot resolve in either direction. And all of that together creates a very specific kind of setup. A setup where short-term weakness coexists with long-term strength. Two things that feel contradictory, but are in fact simply operating on different time frames. A setup where fear, real, visible, headline-driven fear, creates the conditions for opportunity, precisely because that fear pushes prices away from where the underlying fundamentals say they should eventually be. A setup where the next significant move, when it comes, could be substantial. Now, I want to be honest with you about what this does not mean, because overpromising here would not serve you well. This does not mean the market will turn immediately. These phases, the pullback, the consolidation, the period of weak sentiment, can last considerably longer than most people expect going into them. Volatility can remain elevated for an extended stretch. Prices can move lower before they eventually move higher, sometimes meaningfully lower, in ways that test the conviction of even patient long-term holders. But for long-term investors, the kind of investor this channel is built for, this is often precisely the environment where positioning begins. Not when everything feels safe and the headlines are uniformly bullish. Not when the trend is obvious and everyone has already moved. But when uncertainty is high, when sentiment is weak, and when the easy, comfortable narrative is the bearish one. Because that is when assets get genuinely repriced relative to where sentiment sits. That is when expectations reset to levels that no longer reflect the optimism of the prior run. And that is when the actual foundation for the next leg of the trend gets built, quietly, while most of the market is looking the other way. So the real question is not just where gold is sitting today, or what this week's chart looks like. The real question is, what conditions are being created for tomorrow by everything that is happening right now? Are we moving toward a world of genuinely tighter policy and sustained financial stability? One where inflation gets fully tamed, debt burdens become manageable, and the structural pressures we have discussed simply resolve themselves without further intervention. That is one possible path, and it is the path the current short-term price action in gold and silver is implicitly betting on. Or are we moving toward a world where central banks are eventually forced to respond to rising stress with renewed support, where the policy trap we described earlier resolves the way it has resolved in essentially every previous cycle, with liquidity returning and rates eventually coming down regardless of the inflation picture, because the alternative becomes too costly to tolerate. Because if it is the second scenario, and history, debt dynamics, and the behavior of central banks buying gold right now all point in that direction, then what we are seeing today, this pullback, this sell-off, these bearish headlines, may not be the end of the move at all. It may be the beginning of the next phase. And this is where I genuinely want to hear from you. Do you think this drop in gold and silver is a warning sign that the rally is over? That the structural story we have been tracking has finally run its course, and it is time to move on? Or do you see it, based on everything we have just walked through, as a temporary pullback before a larger move higher? The kind of reset that has preceded the strongest phases of every previous cycle in these metals. Let me know your view in the comments. I read every single one, and your perspective genuinely helps shape what we cover in future videos. If you want to go deeper into these shifts and stay ahead of the major changes happening across the global financial system, you can join the Untold Empire email list. The link is right below this video. And if you find value in this kind of research and want to support the work directly, you can do that by buying me a coffee. Every contribution helps keep this research going.